Good morning, ladies and gentlemen. Just after 9, I think, let's go. For those of you who don't know me, my name is Dave Beattie. I'm the Legislative Compliance Manager at HRTorQue. I've got 26 years experience in this industry. First 6 years of my career at SARS in various audit departments, and after that, almost 21 years at HRTorQue. I work in the PAYE, SDL, COID, income tax space, small to medium businesses across the country. Also doing a little bit of work in terms of compliance in the UK now. So today we're going to chat about quite a topical issue, and that is the tax consequences to employees of a couple of issues that have been raised because of the COVID-19 pandemic. We're going to look at one or two issues that are specific to the COVID-19, and then we're going to look at some tax matters that apply to your income tax return. We're also going to look at travel allowances, and what we'll do is at the end we will chat about some of your questions. My co-pilot today, Akila, will remind me, and then we'll just chat about some of those issues at the end. So I think let's just work through the agenda as I've set it out. So we're going to look at, as I said, the home office concept. We're going to just look at this virtual office. We're going to look at some general tax rules. We're going to look at who qualifies for such a deduction. We're going to look at how you arrive at the expenditure that you can claim, what can be deducted. We're going to look at a calculation, just an example, and then we're going to look at how you declare that on your tax return, how you deal with SARS, because you are going to have to deal with SARS. We're going to look at capital gains implications of this home office. And then we're going to move on to the travel allowances and your 2020 income tax return. Okay, so the home office concept is really not new. It's been around for a long time. It's a topic that SARS is not crazy about, because SARS doesn't like to give anyone expenditure relating to private, well, even remotely relating to private expenditure. And your home, but there is provision for it in legislation. There's no actual section of the Act that specifically discusses home office, but we're going to look at the general sections just now that deal, well, the sections that would allow such expenditure to be claimed. Now, obviously the COVID-19 pandemic has caused total chaos. Literally overnight, we had our lockdown imposed on us, and companies had to scramble to get employees up and running so that overnight they could effectively work from home. We've had a lot of this, obviously the lockdown requirements over our head, and we've had, talk of things only getting back to normal at level 2. So I'm aware of most companies obviously having employees still at home, trying to provide a service. And as I said, that happened overnight. So there was very little chance to look at the niceties of what tax legislation said. So, as I said, overnight, employees are now in this new working culture. I know myself personally, the dining room table became my friend, and my son and I sit there and work from there in a nice, efficient little workspace. But as you'll see later, the legislation in this regard doesn't cater for my specific circumstances, and it certainly wouldn't cater for the majority of people's circumstances who are now working from home. Employers would have also been faced with challenges as to how to fund this home office. A lot of companies have gone the allowance route. Some companies are asking employees to provide details and gain the reimbursement route. We'll chat a bit about that later. But the home office in general, a lot of companies, even before COVID-19, were looking at this legislation because of the cost of office space, the cost of parking, traffic congestion, and just flexibility. I know there's a lot of our clients who have office space that doesn't cater for all their staff, and their staff literally have to book space in the organisation so many days a month. It makes total sense. There's no reason for the majority of those people to be commuting, polluting the environment, obviously creating traffic congestion, when they could be at client-facing or be working from home. So the home office option is a solution to that. But we talk about barriers that this home office or virtual office creates. Certain appointments on Monday, and the clients quite interestingly mentioned all of these issues. And we've seen this from our own organisation perspective. It's very difficult to maintain a corporate culture when employees are not centrally located. There's communication problems, there's additional admin burdens, but obviously with things like WhatsApp groups now and Zoom and Teams meetings, a lot of these things have been made easier. But things that you can't control, things like the employee professionalism, supervision, huge problems. Because in your workspace, you could have rules and regulations that prevent abuse of private phones at work, or obviously limit the number of smoke breaks that you have. But when employees are working from home, it's very difficult to supervise and manage these areas. It's certainly not possible to micromanage people from home. So, our client mentioned, clients phoning and you've got children screaming in the background, or you're bouncing the baby on your knee trying to feed it while you're trying to talk to clients. All these things impact on professionalism. And look, I know we've all become quite familiar with the challenges that people face. It is difficult if you're upset or disappointed in the service that someone's providing you, and then when you phone them, they're bouncing the baby on their knee. That's not obviously the professionalism that most organisations would want. We then move on to the security issues. Obviously, in your workspace, you can have state-of-the-art security. At home, that all goes out the window. So it would probably be a good idea to have some basic guidelines for those employees working from home to limit the risk that your organisation faces. And one thing I didn't put on the slides is the POPI legislation. It's a lot harder to control people's private information when you're working from home, because you can't see what an employee is doing. As I said in the beginning, there's no specific authority in the Income Tax Act that deals with the deductibility of home office expenses. So we would look at the general deduction formula, section 11A. And this section of the Act states that the deduction will be limited to the taxpayer who is on a trade, which includes every profession, trade, business, employment, calling, occupation, or venture. So that's quite a wide definition. So in the circumstances that we're going to look at now, those examples would fall into the definition of trade, business, employment, calling, occupation, or venture. As I also mentioned earlier, we do have legislation, and it's the dreaded Section 23B, which prevents the taxpayer from claiming domestic or private expenditure. So any audit that SARS do, they're always looking, whether it be an individual, whether it be a company, that domestic or private expenses are not being claimed. And because we're dealing with an employee, they're going to be even more eager to scan and audit any claims. As I also mentioned, there's some exceptions that recognise that the taxpayer may incur expenses that are incurred partly for trade and partly for private purposes. And these would obviously include the home study. And as you can see, when we work through an example, there is a way that has been set up by SARS that will allow you to deal with the apportionment of such expenses. Now, who would qualify for such a deduction? The legislation covers independent contractors and slash self-employed persons, but as the majority of the people who this webinar is aimed at are employees, we're going to cover legislation that deals with employees. And I'm going to be looking at two specific categories of employees in that the legislation makes a distinction between employees who derive their income from employment mainly from commission or variable payments or any payments that are based on work performance, okay? And then the second category is your stock standard employee who receives a salary. Obviously, the first category, those who earn variable remuneration, i.e. commission, they have a much wider opportunity to claim expenses incurred in the production of that commission than what an employee earning a salary would get. Before you can claim a deduction, the employee has to prove that his income from employment is mainly from commission or variable payments, or alternatively, he can prove that his duties are performed mainly in an office provided by his employer, where there is no office provided by the employer. So, as I said to you, we've got the two scenarios: the commission earner and then the salaried employee who doesn't have an office provided by his employer. Starting point for this process is a letter from an employer. I urge you to issue those to people who don't have access to an office at the actual work premises. And it doesn't have to be anything ridiculously complicated. It would just say that the employee is required to work from home as they do not have office or workspace provided by the employer at the office. The employee must spend more than 50% of their working hours working from the same office. Because if they don't spend more than 50, then it's not mainly. And the word mainly is critical in this area. If you don't work mainly from the home office, you're not going to qualify for a deduction. The most controversial one, the employee must have an area of their home which is used exclusively for this purpose. Now, there's lots of court cases. I haven't included that because I didn't want to make this presentation too technical, but it must be used exclusively for this purpose has shot numerous taxpayers in the foot. Should SARS do an investigation and come to your home and find sports equipment, knitting machines, or any other hobby stuff in this room, they're going to regard it as not being used exclusively for business purposes. The dining room table, as an example, would not qualify. So under the legislation as it stands, I wouldn't qualify for home office deduction. It must be a separate office used exclusively for work purposes. It must be furnished and set up for the purposes that you need it. Now, obviously, COVID-19, as I said in the very beginning, has put a spanner in the works here, and we've got a situation where people are working from all over their home, whether it be the dining room table, sitting in the corner in the lounge, sitting on the couch, using a coffee table. People have been forced to work from home. And as I've just said, SARS would not allow you to claim office expenses in these circumstances. But legislation was never designed to deal with the COVID, well, such a thing as the COVID-19 pandemic. So the Para-Authors Group of South Africa is actually in negotiations with SARS to look at some sort of a softening of the terms and conditions here, so that some leniency slash latitude can be provided to employees who are genuinely working from home. So not people in production, people who finance, administration, anyone who would just use an internet connection as an example and a phone to deal with clients to be pulled into this net. As of this point, we haven't had any response, but as we're dealing in the 2021 tax year, we've still got a long time before the tax return is due. So I'm hoping later this year we'll have some sort of a response from SARS. As soon as we do, I will put out a newsletter in that regard. The office must be specifically equipped for the employee's trade, so furniture, tools, equipment, printers, etc. As I said, multiple uses would not be accepted. So I've just listed some expenses here that we could use we could claim, and the common expenses are the interest on your bond or your rent, okay, repairs and maintenance, lights and water, maids' wages, household insurance, rates, security. As you can see, those are all common. Then we get specific expenses. So these are expenses that will be specific to the home office. Wear and tear on your printer, your chair, your table. If there's a specific telephone in that office only used for business, that expense. Repairs in the study and books. And you'll see an example that we do a bit later with how this all comes together. So how do we calculate the home office deduction? I've listed the 3 steps. The most important of these steps is to calculate the square meterage of your home. So the undercover square meterage and then the square meterage of the office. SARS will not even tolerate a deduction unless you have clearly spelled out this square meterage. Once you've got the 2 square meterage, you can work out a percentage. So it might be 12% or 10% of your home is your home office. Now we've got a good starting point to apply that to expenses. So we apply that percentage to the total home expenditure to calculate the portion of that expenditure that relates to the home office. Step 3 is to add specific expenses. So we've got the proportion of common expenses. Now we add specific expenses to get to the total that you can deduct. Now, I suggest that when you're doing this, that you set it out in the following way. The percentage, the calculation at the top with an explanation, the common expenses, you apply the percentage of your office to the total home, to those common expenses to get a rand value. You then say specific expenses, and then you list those, and then you total it. So what we can do, we can look at a quick example. James is an engineer who works for Smart Engineering. He only earns a salary. His company's happy for him to work from home because he's got all the computer equipment and software to deal with these issues. The office environment is noisy and unprofessional, so it just makes sense for James to work from home. In this case, James has a separate office. He's got a desk, cupboard, computer, and printer, which he uses exclusively for his job. And I've made it nice and simple. I've said his office is 10 square meters of a 100 square meter home. So you can see quite easily there that James would be entitled to claim 10% of the common expenses of this home, plus the specific expenses. So James has spent 100,000 Rand in terms of bond interest. He's got 25,000 Rand in terms of rates and electricity, 20,000 Rand in terms of the maid salary, 4,000 for house repairs, and then he spent 12,000 on his cell phone expenses. Okay, so to summarize, why can James claim a home office deduction? Firstly, he's required by his employer to work from home. Hopefully he's got a letter. Secondly, he's got a dedicated home office furnished for business use only. Thirdly, he's kept records of expenses to maintain the whole house. Fourth, he's apportioned these expenses according to the floor space. And then the fifth reason is he's prepared a schedule of the expenses in the format that SARS required. So we know that the home office is 10% of the floor space. We know that the total home office expenditure is 149,000. So you can see there 10% of 149,000 is 14,900 Rand. Now, it's important to note that you cannot claim the 12,000 Rand cell phone expenses, okay, because James is a salaried employee. He's not a commission earner. As I said to you in the beginning, the challenge that you've got is the commission earner is entitled to expenses incurred in the production of income, and they have a lot more latitude than the salaried employee. So in this case, James cannot claim his 12,000 expenses. He would have to put in some sort of a reimbursement claim to his employer, and that comes with its own challenges, in that there would have to be an itemized billing, cell phone statements, and he would have to prove to his employer the business calls made. Now, as I said, the specific expenses can be claimed in full. So those we would add wear and tear on any assets, repairs to the study if there were specific repairs, or he bought any books. Now, the thing that's going to get you, obviously, a SARS review / audit is you as a salaried employee on your IRP5 don't have any income codes that SARS are expecting deductions against. So you would claim in other deductions on your tax return for this home office. And I can tell you with certainty, every single time you put something in that field, SARS are going to send you a little letter asking you to confirm what you claimed with it. And then you're going to have to supply all the documentation that we discussed earlier. Have all that ready, have a nice little spreadsheet ready, the employment letter, the apportionment, and obviously keep it simple. Don't try and boost your deduction by putting in private expenses, because that's going to get you into trouble. Now, unfortunately, there is this nasty term, capital gains tax. So working from home creates a capital gains implication. Now, when a taxpayer sells their home, there's a 2 million Rand primary residence exemption that SARS apply. Each taxpayer also gets 40,000 Rand capital gains exemption every year. So depending on the capital gain, depending on your, obviously, how much your home was sold for and the circumstances, there might be a capital gain implication, relating to the use of this home office. Now, the calculation would obviously be an apportionment. You would only pay a capital gain on the proportion of such gain that your home office was to the total floor space of the property, and also the period over which you had this home office. But you know, if you do computations and you do some examples, the tax implications here are quite minor for your average person, and in most cases you probably wouldn't end up with any capital gains implication because of the applicable exemptions. But it's just something that you need to keep in the back of your mind before you rush out and you do you do a home office implementation. Travel allowances. Now, travel allowances is probably the only place really that employees are still abusing the deduction. SARS are very aware of this, and there has been talk of doing away with the travel allowance completely, the fixed travel allowance, and SARS insisting that taxpayers only use the reimbursement. Now, that would put the cat amongst the pigeons, because your employer might be happy to pay 5,000 Rand a month towards your fixed travel allowance, they might not be prepared to pay 3 Rand or 4 Rand or 5 Rand per kilometre based on the fraudulent mileage that you might put on your logbook. So we watch this space with bated breath at the moment. But the immediate challenge to us due to COVID-19 is when we set up a travel allowance, you should be using the employees, the cost of the vehicle that they use to do their business travel in, and their mileage per annum, and their business mileage per annum. There's a SARS formula that we use to work out what the optimum fixed travel allowance is per annum, and you should be using that. I know that most employers don't. They put what the employee wants because people work on a cost to company basis. But as I'm going to talk about later, not very good policy, and I would advise the company to have a proper travel allowance policy. So back to COVID, we've got our fixed travel allowance of say 8,000 Rand a month. We're paying tax on either 20% or 80% of that. Most of us obviously don't do enough mileage to qualify for the 20%. So of your 8,000 travel allowance, you're paying tax on 80% of that per month. And we go through the tax year. But COVID-19, as of the 27th of March, we went into a hard lockdown, and for 2 months, there was no travel. So those of you who are putting in travel logbooks for the 2021 tax year, if there's any mileage put in that period, you are going to be put under the microscope, and obviously SARS are going to throw out your travel claim because they're going to say that it's fraudulent. So where does it put the employee? If your travel allowance is inflated, you're going to have a challenge for the following reason. So we accept that 20% or 80% of it is taxed. We're assuming that there's a logbook, okay? We then look at what's happened in the month. You pay tax on 80%. So what happens is, on assessment, the other 20% is added to your taxable income. Now, in an ideal world, if you've done your calculation correctly, what will happen is your travel deduction that you work out on your annual tax return will wipe out the 20% that you haven't paid tax on a monthly basis, and you'll get a refund. But if you've highly geared your travel allowance, and because of COVID, you just can't get enough mileage onto that logbook, you're going to have a problem. So the challenge is always to make sure that you've got enough mileage to wipe out the untaxed portion of your travel allowance. In my case, what I do is I always design my travel allowance in such a way that I can prove business travel to the extent that I get all the tax back on my travel allowance. So I get the 80%, the tax on the 80% monthly back on assessment. So let's look at the situation where you haven't traveled for 2 months. You don't do a lot of travel, and you rely heavily on what you do travel for business to justify that on your tax return. Now, you don't have those 2 months, so you can have a challenge. If you submit your tax return on that basis, you're going to have a situation where you're going to owe SARS on assessment. So what options are available to the employee? You can either reduce your travel allowance over the balance of the tax year to better reflect what you think your deduction is going to be, or you can ask your employer to deduct additional tax. I personally wouldn't do that because I don't see why SARS should get your money in advance. Or you're going to have to accept that on assessment, you're going to owe SARS money. So any one of those three are acceptable. I know there's been a lot of scaremongering about this process. I know articles have been written about it, but quite frankly, this is a very simple process. If you're paying tax on 80% of your travel allowance, even without 2 months worth of business travel, you shouldn't be in a situation where you owe SARS tax on assessment unless you've been reckless or you've allowed your employee to dictate a travel allowance that is above what they should have. Bearing in mind that a good travel policy shouldn't allow an employee a travel allowance of more than 35 or 40% of their cost to company. The reason I say that is SARS are very aware that people abuse the space, and SARS will come and ask you whether you think it's appropriate that you're actually working for a travel allowance. You're not. You're working for salary. Travel allowances provided to you to allow you to do business travel in your private vehicle. So, as I said, have a good policy, something that you can show SARS if there's an audit, and you've got nothing to worry about. So, don't listen to all the scaremongering. I'm moving on to some SARS issues over the TERS period. Now, a lot of employers were caught on the back foot here. What I've done is I've included some information from the payroll authors group. This is a slide that I've taken from the payroll authors group. But with the implementation of the lockdown, a lot of companies had paid or run their payroll by the time legislation was put out for comment, and definitely before it was promulgated. So a lot of companies also didn't understand the TERS concept, in that the TERS concept was effectively UIF money that was being paid to the employer as an agent to pass it on to the employee. Now, UIF money is exempt from tax in terms of section 10(1) small n capital B. So whether it be UIF money or TERS, it's the same. It's the same thing. TERS is just obviously the UIF payments in this COVID-19 period. So that any payments in terms of TERS will not have PAYE, SDL, or UIF deducted from it. I know that there were employers who were deducting pension and other levies from it. That was their own business. If they negotiated that with an employee, that was fine. And we obviously recommended that it was a negotiation, it wasn't a compulsory thing, because obviously during the TERS period, people were earning a full salary. But we also had lots of challenges around how to reflect salary on the pay slip. Isn't it an advance? Are we setting leave? And we saw at least 80% of companies, maybe 90%, messed this up significantly at the time. And we've had to go back and rerun payrolls, to put in what we call TERS advances. So the way you did it, if it wasn't planned correctly, you could have got the employee into trouble in terms of when they were receiving salary, when they were receiving TERS payments. An advance cannot be. You cannot just call something an advance and never bring it into taxable income, because you're effectively advancing an employee taxable income. So we suspect there's going to be a lot of companies out there that are going to have huge challenges. Should there be a UIF or whether there be a SARS audit in terms of how they reflected the income over this period. I've also included SARS confirmation in terms of the declaration for TERS purposes. That TERS, you can reflect it on the payslip as a TERS payment. There's no IP5 reporting requirements for those payments. Okay, we move on to our last topic, and that is changes to the tax filing season. I think SARS have pushed in a sneaky little thing here, in that we all know that tax filing season starts on the 1st of July every year. I know that most people have their tax stuff ready and waiting because they want their refund. I certainly have. And then we were told that it was getting pushed back. And obviously SARS have done quite a good PR job. It hasn't washed with tax consultants and accountants because it's pushed us into a corner here. But SARS have used the COVID process to effectively hold back the payments of billions worth of refunds from July through to September. Because now those people who are claiming the significant bulk of the refunds can only submit their tax returns after the 1st of September. So what I've done is I've included the 3-phase process that SARS have published. I just want to go through it quickly for you. Phase 1 hasn't changed. That phase, basically from the 15th of April to the 31st of May, your employer or any other third parties has to get their acts into gear and submit third-party documentation to SARS, whether that be in the format of an RP5, RT3A, RT3B, if it's interest, RT3C, if it's capital gains, RT3, I think it's S, if it's tax-free investments. So anything that you earn as a taxpayer that is managed by a third party has to be submitted to SARS on the 31st of May. Now you'll see where we're going with this when we talk about phase 3. Now, phase 2, a bit of a warm, fuzzy, fluffy phase. This phase was from 1 June to 31st of July. You would have noticed as a taxpayer or as a consultant, lots of SMSs coming out, asking people to update things on their tax profile or telling them that there's incorrect issues on their profile. So during phase 2, 1 June to 31st of July, third parties and employees have to get corrections submitted to SARS. SARS will issue what they call auto assessments. We've seen a couple of those in previous years. Taxpayer notified that they can auto assess, and there's nothing to be concerned about. SARS believe that quite a lot of taxpayers will be able to auto assess on the basis that third parties would have supplied all the documentation for them to pre-populate the tax return. Now, those of you who do your own tax return will know that over the past couple of years, SARS has started to pre-populate more and more fields. Now, the aim is obviously for all third-party payments to be pre-populated on the tax return so that you can't cheat. So any interest that you receive from a source in South Africa or anyone reporting to SARS would be on your tax return automatically. So in an ideal world, if you're a salaried taxpayer having an RA and medical aid, no additional medical expenses and some interest, all of that would be on your tax return. You could literally open it, check it, and then accept the auto assessment. Obviously, if SARS auto assess you and you've had ridiculous amounts of additional medical expenses, you can add that in and have it reassessed. So in an ideal world, going to be a bit easier, but I think SARS have overestimated the number of auto assessments that they think are out there. Individual taxpayers who are not required to file returns will also be informed. Phase 3 is the major phase, and that is 1 September to 29 January 2021. Filing season for those taxpayers where additional information has to be added to their tax return. Now, if you're using e-filing, you can get your return in between 1 September and 16 November. As you can see, that's quite a compressed reporting period, because normally we have from the 1st of July to the 16th of November. And then if you a technophobe and you don't want to use e-filing and you want to go into a SARS branch, you've got between the 1st of September and the 22nd of October to go and do your tax return. Obviously, with COVID-19, you're going to have huge problems doing that, and you're probably going to have to make an appointment. So good luck with that. I would suggest getting the help of a practitioner. And then if you're a provisional taxpayer, you've got from 1 September to the 29th of January 2021 to get your return in. As I said, it's been compressed significantly and just putting practitioners under a huge amount of additional pressure. We've come to the end of the webinar in terms of legislative content. We're going to have a look at some questions. Okay, how do employers treat employees who are not at work? That is more of an HR question, not a tax question. What I would suggest is you contact me and you chat to Nikki in that regard. In terms of the home office, though, anyone who can't be at work due to an infection can still work at home. You know, it would be the same terms and conditions as anyone else from a tax perspective. Obviously, from a HR perspective, our HR team will be able to assist you. Okay, so what is the minimum time month spent for having a home office? To the best of my knowledge, there is no such minimum time. If you're required to have a home office for 3 months, as I said before, this COVID thing changes the ballpark significantly. I'm thinking that SARS are going to be a little bit more lenient in this regard and accept the home office for the COVID-19 lockdown period. Now, obviously, a lot of people will be at home for extended periods, like for my example, myself, until we get through the peak of the COVID transmissions. So, no such, there's no legislation that says it has to be for a full year or a part of a year. So let's see if there's any more questions. Kim, what is the calculation for travel allowance optimization? Okay, so your travel allowance formula, if you go to any text little booklet, you know, those booklets you get when you go to the seminars, you'll see there's a fixed, there's a travel table that gives a fixed cost per employee, car in certain brackets, and then it gives a fuel and a maintenance cents rand value per kilometer. Okay, you would use that formula, so you would go to the formula and you would say my car fits into that category. So the fixed cost for that category is 56,000 as an example. You put that figure over the total mileage that the employee does in the tax year to get a rand value. Okay, you then add the value per kilometer for maintenance and fuel to get a total value per kilometer. And then once you've got that total value, say that is 7 rand 10 cents per kilometer, you would multiply that by the expected business kilometers that the person's going to do in a year. So if you multiply that by the business kilometers and you get 120,000, it would make sense that you give the employee 10,000 rand a month travel allowance. So that's 10,000 rand times 12 months is 120,000. So to recap, you need to go to your fixed travel tables. You need to see in that sliding scale where your vehicle fits in terms of original cost. You need to put that figure over the total kilometers that you expect to do to get a rand value. You then add the rand value per kilometer for fuel and for repairs and maintenance to get a total value per kilometer, and then you multiply that by your expected business kilometers to get a total. You divide that by 12. Now, anyone who has a problem with that is welcome to contact me, and I'll email the actual steps that they will follow. Trevor, can we report an employee for not applying for the TERS benefits? That is a question, Trevor, that our HR team would be more familiar with. I'm not sure that it is compulsory that you apply for TERS, but I think it, from a moral standpoint, I don't think it would be right if you short paid a person and there was a TERS benefit available that you didn't help your employees. Quite a nasty approach if that's what the employer meant. Tessa, it's a pleasure, Tessa. So I'm just. If you claim your data brought because of working from home and Vodacom just loads it on when purchased without an invoice, how do we claim? Very, very complicated, Nirvana. Look, SARS are not heartless. What I would do is I would provide whatever documentation you can get to prove the value, whether it be itemized billing or, even when you go and you buy airtime, keep slips, SARS is just going to look to see whether you've been reasonable. The employers applied some sort of logic, because remember, SARS also understand that your employer doesn't want to give you money for nothing. And that's why I said in the beginning, it's quite a good policy for employers to have a policy of how they're going to deal with these issues, home office and expenses. And that would probably fit into the general reimbursement of expenses that your employer should have. It's a critical element, because as an SARS auditor, I would look at the steps that the employer had applied in this process. Now, if you've got a very laissez-faire approach to reimbursing employees, you're obviously high risk, particularly if they're senior managers who are looking to boost their monthly remuneration, putting in private expenditure. SARS will take a dim view on that. But if you've got a form that has to be completed and then signed by a manager and then signed by finance before it's reimbursed to you, and you've done your best to arrive at a legitimate expense, you won't have a problem. Sharon, please. Okay, the auto transfer process. Sharon, yes, I've received, I haven't done one yet myself, but I've received lots of correspondence from colleagues talking about how difficult it is, particularly when the poor taxpayer is clueless about technology. I know that they have complained to SARS already about this process, saying that it's overly complicated. And as you quite often said, if you don't have the correct details on the system, you've got no idea where this PIN is being sent to. So, similar to internet banking, you get your PIN, things should be quite easy. You can put that once-off number into the system. Not ideal. Just want to see if we got any more. Okay, Sharon, last question. I get clients to do affidavits for home office expenses with a clause stating that they understand the consequences of perjury. Look, that certainly won't do your cause any harm. Once again, it's important you got paperwork in place. As an ex-SARS auditor, if you want to block me, if you want to firm up an opinion in my mind that this organization is legitimate and they do things according to the book, have processes and controls in place. Alternatively, you come in there and it's a free-for-all. Your audit's going to be a couple of weeks longer if that's the case. if there's a policy and procedure and a control process for everything, then you run a very good wicket. If that's all, thank you. Sorry, there's one more question. Look, a home office allowance, yeah, it could be a good thing. Murray, if you want SARS to see this person's got is actually getting paid an allowance, yes, that's fine. I have no problem with that. Also, probably a good policy because you've applied your mind in terms of the expenses that you think the person's going to incur. That combined with the letter really firms up your process. I quite like that. And you know, there's not a RP5 code for that, so it'll probably be another allowance, but on your payslip, it will quite clearly show home office allowance. So yeah, I'm happy with that. Okay, that's the end of the road. Thank you so much, guys, for attending. And you know, if you want to be added to our newsletter, there's no marketing or fluffy stuff on our newsletter. It's all legislation related. It's all there to help you to spark something in your mind to fix things. Just let us know, please. And yes, same if you want to be added onto the webinar list for all sorts of webinars and interesting information. Yeah, please let us know. So thank you for your time and have an awesome week. Thank you. Cheers. Bye.